Well, I wanted to look at two different charts today to introduce the topic for a couple of reasons. I'll get to the second one here in just a minute, but first let's jump into one of these charts as we discuss where I think there might be an opportunity here, particularly this week. So this is actually a stock chart that we're looking at right now. This is DAL. If you don't know what that is, it's Delta Airlines. So Delta Airlines, U.S. air carrier, in a bad situation, would have been great to short this stock or even buy puts on it. For those stock traders out there, you probably have been doing things like that as well as shorting the banking sector. Those have been pretty safe bets over the last little while. But let's contrast this chart with another one in the same industry. This is another stock symbol. The symbol is LUV, and we recently wrote an article on the site about using LUV, which is the stock symbol for Southwest Airlines, another U.S. air carrier. And we were contrasting the benefits that they're receiving by hedging against their energy risk and their better competitive position in the airways industry. So they've more effectively hedged through the derivatives market, forwards, etc., against rising oil prices, and are therefore not under this, don't have the same pressure of the other airline carriers to raise fares the same rate or to charge for auxiliary services like baggage check, etc. And you'll notice that over the same period, LUV has had a choppy but an uptrend. This is certainly a stark contrast versus DAL. Even the stocks are priced at about the same level, but one is clearly outperforming the other. Now, I'm going to stick with the stock market here just for another second, because for those of you who are looking in other capital markets, including the stock market, you'd have to ask yourself, well, this is an interesting example, but I'm not interested in the airline going long the airline industry. Period. It's a bad bet, and to a certain extent, I would agree with that. But one of the ways in which stock traders will take advantage of opportunities like this is that they will they will invest on two stocks that one is very likely, whether they both trend up or not, or both trend down or not, what they'll do is they'll try to leverage one versus the other. So a very fundamentally well-managed stock versus a fundamentally poorly managed stock. And in that way, if we were using these two stocks, they would be shorting the Delta Airlines, DAL, and they would be going long LUV. And that does a couple of things. The assumption is that if the airline industry itself collapses, or rather continues to collapse, then Delta Airlines would actually fall in value on a percentage basis faster than Southwest, which is likely to serve as a hedge in that industry. So that short position on Delta would improve in value and offset the potential losses from the long position on Southwest Airlines and net out to a profit. Conversely, the same thing is true on the other side. If the airline industry were to take off, investors would be drawn to LUV, which would appreciate in value at a faster pace than DAL, which would be considered the lower class stock in that case. So if you're going to bet on an industry, you might as well pick the winner. So the gains from Southwest would offset the potential minor losses or from the short position on DAL. In that way, what they're basically doing is they're trying to neutralize their risk that is focused on the industry itself going up or down, and instead focus on playing weakness against strength. Well, I use this example because right now in the Forex I'm seeing some issues that are kind of more or less global wide. There are some problems that we're dealing with, and from an interest rate perspective, I see that there is more risk, or there is risk beginning to pile up on some of these interest rate leaders versus some of the interest rate laggards that I think this week is the perfect example. Let's go look at a couple of currency pairs. I know that there are a lot of folks, myself included, that have been long the Aussie dollar for a long time. And one of the reasons why we've been long the Aussie in particular is because of the interest rate differential. So 7.25% currently, and in fact they're due tomorrow to come out with a new statement from the RBA and a cash rate announcement. Well, what are expectations for that announcement? Right now, I think if you were to ask most traders, they would agree that the cash rate announcement is expected to come out at about 7.25%, no change. And the rate statement, or the comments that come out from the central bank, are likely to be be perhaps not as hawkish as they have been at other times in the past. So there is some volatility building up in this particular currency pair. And you can see that really exhibited here as the market is against, again, a long-term resistance level. So this is a long-term high. We've been bumping up against that level for a couple of months, tried to break through even today, and the volatility just really pushed the market back down. Well, this is interesting. So we look at this and try to determine, well, is there a way that we might use this information in the same way that we might have used a similar analysis in the stock market with DAL and LUV? Well, let's contrast this with another currency pair that is due for a big announcement this week as well. All right, the euro dollar. Now here we're expecting something different. So the euro has been an interest rate laggard, at least compared to the Australian central bank, the RBA. And most traders, if you were to ask them today, where do you think interest rates are going to go on the euro as of this announcement this week? They're probably going to tell you it's going to go from 4% to 4.25%. So an interest rate increase. There was even some really good news that was being interpreted all kinds of different ways, but from the BIS in Switzerland about the need for higher interest rates, including in the eurozone. So we're anticipating rising interest rates there, stable interest rates in Australia, and overall that changes the way we would look at the relative strength between those two currencies or those two currency pairs. Well, obviously there's a way that we can cross these. So let's look at at applying this in a specific example, because this is a lot easier to do in the Forex than it is necessarily in the stock market even. All right, so obviously what I've done is I've crossed the euro with the Aussie dollar, and you'll notice that on this particular pair, we're lining up on a fairly interesting support level where the market has been responding dramatically to this particular level. So when we see consolidations or bounces off of this level as support or resistance within this channel over the last couple of years, the market has responded energetically to those touches here. We've just barely bounced up off of the 1.6050 level here recently in June, and as we're coming into July, we're still kind of stuck within this consolidation, beginning to form a potential inverted head and shoulders pattern, where the market has made a series of lows, one of which, the head of which, touched that support level. We've bounced up, we've made another shoulder here on the right-hand side, and we're just bumping up against this neckline. So is this the opportunity that we have to use that same concept of leveraging weakness against strength, or potential weakness against strength, against potential strength in a investment to the upside here on this particular currency pair, where we're making the assumption that the euro is going to gain in value against the Aussie as we continue to see rates rise there, and the buzz or the expectations for increased rates there versus overall the expectation that interest rates are going to stay the same or even decline in Australia. A breakout here takes us from 65 to potentially the top of the channel, which is, if we draw a line across these first two tops, we more or less bisect this consolidation that occurred here earlier this year at 71. Well, that's, we've got 600 pips worth of value here between the potential breakout versus resistance at the top of the channel. So maybe a way for us to diversify some of our investing out there to hedge against potentially a weakening dollar for those of us who are long the Aussie dollar, for example, by playing the Aussie against a currency that appears to be showing a trend for potentially higher interest rates. So interesting opportunity, and I think is a nice correlation between strategies that are being played today in the stock market for similar reasons. For those of you who are interested in some of the things we talk about in the intermarket environment, in particular stocks, options, futures, we're very happy to announce that we've launched a sister site to pfxglobal.com called learningmarkets.com, in which we have a lot of education. In fact, we have 9 full courses on stocks and stock options, as well as, of course, Forex, where a lot of the PFX content is hosted as well. So I would encourage you to check it out. We have a lot of, it can be a great way to diversify your portfolio risk across more than just a single market. Obviously, it's great to be able to diversify your risk and take advantage of opportunities in the forex, as well as commodities markets, gold, oil, etc., and even the stock market, equities, bonds, etc. There's a lot of content here that you might find interesting, so we'd just like to have an open invitation. Anyone can come here and check it out. It's obviously all free, and we think of the same quality and content that we've been trying to provide at PFX Global. So come check us out.